So it's more or less a Fed watch tool. You can see that for the next thing, there's 100% probability they're going to cut interest rates. The question is, are they going to cut by a quarter percentage point? That's a 70% chance. Or are they going to cut by a 50 basis points, which is 0.5%? That's a 29% probability. And as a result, you can see that long-term interest rates have also boom, collapsed. So ordinarily, that would be bullish for the market, right? We'll come to that in a short while. So the question is, the Fed has been, raising rates and keeping rates high for almost 2 years, and now they finally are cutting interest rates. So usually, after the Fed cuts interest rates, what tends to happen to the stock market? So it all depends on what happens to the economy. So if the economy continues to be strong, continues to grow, then once the Fed cuts rates, the stock market will continue to do well. So in this chart, you can see what happened in past cycles once the Fed start cutting interest rates and there was no recession. The economy continued to do well. So if there was no recession, you can see that there we are, average with no recession. In red, you can see that 12 months later, the market's up about an average about 16, 17%. And 24 months later, the market's up like about close to 40%. Fantastic, right? But if a recession happens, then it's a different story. So you can see that if there's a recession, then you get this orange line over here where the market, 12 months later could be down about, well, actually not that bad. 12 months later it's down like maybe 5% from the top, went all the way down, 15%, then 12 months later down 5%, but 24 months later, it's made it all back. That's why I say in the long run, don't worry, because whether there's a recession or no recession, long run, the market always goes up, right? So, but understand that it is not the Fed cutting rates that could potentially cause a recession. The recession happens because the Fed kept rates high too long. So remember, here's the analogy, right? The economy is like a car. When a car is going too fast, it overheats. That's like inflation. So to slow the car down, the Fed has to raise interest rates by stepping on the brakes. So for the last 2 years, the Fed has been stepping on the brakes to slow the car down. So if the Fed is able to slow the car down without the car stalling, that's great. But now there's a fear that, hey, the Fed has stepped on the brake too long and now the car could stall. The economy could go into recession. And then we could be in the shit house for the short term. Now, yesterday was a pretty interesting day in the market because initially, after Jay Powell's speech and people felt that, the Fed's going to cut rates, people were all optimistic, right? So the market actually opened high yesterday, showing that this pullback may have bottomed and we're going to bounce back higher. But then suddenly, during the trading day, what happened? Everything reversed down and the market closed sharply lower yesterday, although it did close above the 50-day moving average. But current futures are showing that the market could go lower today. It all depends on 8:30 a.m. Eastern Time, the employment report. So if we get a strong employment report, then I think futures could reverse up. We could bounce back higher. But if the employment report comes negative, then we could go down a bit more in the short term. So what is it that caused that intraday reversal yesterday? That from going up, everything started to come crashing down. Well, it was the sudden new narrative that the Fed could have waited too long, they're cutting too late, and we could be going into a recession. What was interesting was that yesterday, not all stocks went down. Stocks that are defensive in nature or recession-proof didn't go down. In fact, they went up. For example, you can see consumer defensives. Your McDonald's, your Yum Brands, your Procter & Gamble, your Hershey's, they all went up. In fact, Hershey's reported earnings that was not very good. I own Hershey's, by the way. And despite lousy earnings, Hershey's went up yesterday. Why? Because Hershey's is a consumer defensive stock known to be recession-proof. And what else went up? Healthcare went up. I own a lot of healthcare in my portfolio. And most of the healthcare stocks went up. These are the recession-proof stocks. And stocks that tend to be more sensitive to a potential recession, they fell pretty hard. Like basic materials, industrials, financials, energy, consumer discretionary, and technology. But the interesting thing is actually technology is not really sensitive to recessions. If you look at past recessions, pure tech stocks can still do well during recessions. So I think it's more like a bit of a sector rotation where people are rotating out of technology and going into more defensive sectors, right? And a lot of people expected small caps to rally as interest rates are coming down, but small caps dropped yesterday. Why? Because small caps do very badly in a recession. So a few questions to ask. Number one, what changed the narrative? So just a couple of moments ago, the market was concerned of, inflation is bad. No more inflation, but oh my God, it's a recession. So there's always something to worry about in the market. And the market always finds a narrative to kind of like create lots of volatility. So what changed the narrative? Well, it was actually two things that happened yesterday. The first thing was that the ISM manufacturing index came in lower than expected. The July index came in at 46.8, which was below the expectation of 48.9 and below June's reading of 48.5. So there we are. That was July's reading. You can see was a contraction. So anything below 50 is a contraction of manufacturing activity and economic activity. So that's freaking people. Oh my God, it's a recession. So, but does it mean it's going to be a recession? Well, again, no. There are a lot of false, positive, right? Like for example, take a look at 2015. The index went below 50 as well, contraction, but there was no recession and it bounced back up over there. Here it bounced back up as well. But of course, this was caused by COVID. So if you discount COVID, you can see that, in the last two cycles when it contracted, it was actually no big deal. But again, the market likes to freak out over every little thing. So that's the first thing. The second thing that kind of created a recession fear was that initial claims, unemployment claims, came in higher than expected. So 249,000 unemployment initial claims versus 235K expected, and continuing claims came in at 1877, again above consensus. And the unemployment rate has been ticking up as well, up to now 4.1%. So all this is fanning that narrative that we could be coming into a recession. The Fed has been too late to cut. So are these economic slowdown fears justified? Well, I don't think so. Well, at least at this stage, not yet. Because while there are some negatives you see, there are also a lot of positives. So my job is to show you both the negatives and the positives, and you make up your own mind whether the economy is still going to go strong or tip into recession. So let's look at some positive. Well, a couple of days ago, US Q2 real GDP growth came in much higher than expected. It came in at 2.8% annualized. There we are. That just came in just 5 days ago, which was a re-acceleration from Q1 of 2024. So initially, again, there was a concern that Q3 last year, Q4 last year, Q1 this year, GDP was growing, but at a slower pace. And people were afraid that that was going to lead to recession. In fact, that led to a bit of a market sell-off a couple of months ago as well. But then, just in Q2 this year, GDP re-accelerated. So that was not reported in the news yesterday. So the market tends to have this recency bias. Whatever it sees latest, it gets freaked out about. All right, but it forgets what it saw a couple of days ago. Okay, and this is much higher than the 1.4% growth in Q1. And most of this was driven by consumer spending. Remember, 70% of US GDP comes from consumer spending, and that increased at 2.3% in Q2 versus 1.5% in Q1. So that's looking pretty healthy. What else is looking pretty healthy? Well, if you take a look at the Atlanta Fed GDP now, real GDP growth estimates, this is a real-time tracker that tracks real-time GDP by looking at all the different economic data points. You can see that Q3 of this year, GDP is now forecasted at 2.5%, which is still pretty strong, all right? Now, let's take a look at the yield curve. Of course, we've got some people saying that the yield curve inversion will lead to a recession. And of course, that has happened before, but it doesn't happen all the time. But as I said previously, it is not the inversion that precedes a recession, it's a re-inversion, right? So over here, you can see the 10-year Treasury yield minus the 3-month Treasury yield. So whenever it goes negative, it means that the yield curve has inverted, right? The 3-month is above the 10-year, which is what's happening right now. You can see the 3-month yield is 5.22%. and the 10-year yield is 3.95%. So if you take the 10-year minus the 3-month, 3.95 minus 5.22, it's negative. That means the yield curve is inverted. So we have been in an inverted yield curve for quite a while. So historically, you can see that when the yield curve is inverted and it uninverts, that means it goes back above zero, where now the 10-year is above the 3-month, then it's followed by a recession in the shaded area. Same thing here, inversion, uninversion, recession, okay? Now, it's not a perfect causation. It may just be a relationship, right? Same thing here, inversion, uninversion, recession. But again, that was more of COVID. So where are we right now? We have inverted for a very long time, but we have not yet uninverted. So based on that theory, there's no recession, at least not yet, okay? So that's another so-called positive data point. What else? Now, ultimately, it all boils down to the earnings of the companies. If companies continue to grow their earnings, then the stock market will continue to go up. It's as simple as that. Because ultimately, what drives stock prices are earnings, okay? So right now, we're in the middle of the earnings season, as you guys know. And so far, half the companies have reported earnings. And among some of the big tech stocks, Apple announced earnings, not bad, stock price went up. Yeah, I think it's going up today slightly, right? Meta announced great earnings, stock price popped. Microsoft announced great earnings, stock price went down, okay, even though earnings were great. Google reported pretty good earnings, stock price went down but rebounded a bit. And Amazon just reported earnings yesterday, it was pretty good, I was pretty happy with it. But it looks like it's going to gap down about 8% today. So ultimately, when you hold these companies, don't worry too much about the short-term ups and downs of the stock price. Look at how the business is doing. If the business is growing, that's all you need to know. Because ultimately, any short-term dips is an opportunity to add more shares to great companies. Okay? So out of half the companies that reported so far, we have got 78% of the companies that have beaten their earnings per share estimates to date for Q2 earnings season. This is above the 5-year average of 77% and above the 10-year average of 74%. So in other words, companies are reporting earnings better than expected, okay? At the same time, consensus analyst expectations for S&P 500 earnings per share actually rose during the latest week for 2024, 2025, and 2026. So as a result, forward earnings rose to yet another record high during the week of 25th of July. So over here, you can see these are the consensus estimates for 2026, the year 2026. They are rising, 2025 rising. 2024 is a bit, came down a bit, right? Came down a bit. And overall, the S&P 500 bottom-up forward earnings per share has been rising. So what does all this mean? Basically, the economy is growing, corporate earnings are growing, right? So the probability of a recession happening anytime soon is still pretty low in my opinion. Now again, of course, anything can happen. No one can predict for sure when a recession will happen, not even a top economist. In fact, the majority of economists all predicted that 2023 was a 100% chance of a recession. It didn't happen. So if the top economists can't predict a recession, neither can I, neither can you. But we can just look at the current data to see, hey, are we still growing in terms of earnings and GDP, which we are for now, right? So what can we expect for the rest of the year? Now, if you take a look, I've shown this chart before, by the way. If you take a look at all the past presidential election years, which we are in one right now, you can see that August for presidential election years tends to be pretty bullish, actually. Okay, so if seasonality and history is anything to go by, we should end August up bullish. Again, there's no guarantees, there's no 100%, but this is just based on probability, okay? And if you actually take out 2008, which was the great financial crisis, take that out because that was an election year, but that was a GFC, you can see that all the other election years from August, which made a high, all the way to October, mid-October, the market actually was not that bearish, but it wasn't bullish as well. It was actually in a range going up and down and up and down and up and down and up and down. So we should expect a lot more volatility in this case. So is there money to be made in this kind of volatility? Yes, a lot of money, especially if you learn how to trade options, right? So whenever you see great companies or the index selling off, you can sell put options, cash secured put options. In fact, that's what I do most of the time. And by doing that, I made over $1.8 million in the last 5 years selling put options on very good companies whenever there's short-term volatility. Do check out my Beat the Market webinar where I talk more in detail about how I did that. But if you have got a smaller account and you can't sell cash secured put options, you can always sell bull put spreads, also known as put credit spreads. So with small account, you can do that and get pretty good premium, right? At the same time, after the market goes up, what can you do? You could actually sell covered call options on the stocks that you own. Or if you don't own 100 shares of a stock, you can sell what we call bear call spreads. You can also do iron condors. You can also do calendar spreads in options. So there are many strategies you can use in options to create extra income for your investment portfolio while it's going sideways. And of course, whenever you've got a great company that's dropping to a support level that's undervalued, use that as an opportunity to accumulate more shares. Because ultimately, if the economy continues to be okay and doesn't go into recession, then by the end of the year, we should have a pretty strong rally. Okay, again, of course, there's no guarantees. We can't predict the future. It's just a probability. Yeah. Now, of course, you may say, Adam, but what if? What if the Fed actually hit the brakes too long and we do tip into a recession? Then how? What should we do? Are we gonna die? No. Okay, you're not gonna die. Don't worry, right? Now remember, investing is a marathon. It's not a sprint. We are in this investing game not for 1 year or 3 years. We're in it for 10, 20, 30 years until we die, okay? And during this time in the markets, we will go through a lot of recessions. We will go through a lot of bear markets. It will happen. We just don't know when it's going to happen. The thing is not to freak out about it. The thing is to take advantage of it and to make the most intelligent decisions. So one of the things that I learned is that there's really no point trying to predict a recession. Why? Because like I said, history has proven time and again that the best economists in the world can't predict recession. So if they can't, why do we even waste our time? Okay, that's number one. Number two is that even if we read the economic data and we discover that, okay, there's a recession, what shall we do? It's often too late. Because remember this, that the stock market is not the economy. Write this down. The stock market is not the economy. The stock market is a leading indicator of the economy. So the stock market always moves first. The economy always moves 6 to 9 months later. All right. And I'll show you how useless it is to read economic data to know whether you are in or not in a recession, right? Let's go back to 2020. Now in 2020, we had a pandemic, we had a global lockdown, and as a result, we had a severe recession. And what happened was the stock market went into a bear market. It collapsed all the way down and it bottomed on the 22nd of March. And if you recall, if you were following me at the time, in early April over here, I said that we have started a bull market. And most people were very skeptical. They said, Adam, what do you mean a bull market? Are you crazy? The economy is in recession. We are in shit house. I said, the stock market is not the economy. Look at the stock market, forget about the economy, right? And you can see all these negative headlines in the news. And the more negative the headlines, the more the market began to rebound. Now, here's the interesting thing. When was the 2020 recession officially declared? By the NBER, the National Bureau of Economic Research. The official recession was officially declared on 19th of July 2020, which was here. Okay? So in other words, by the time they said, we're in a recession, it's official, the market already bottomed 4 months before that. And by the time they declared it's a recession, the stock market had already gone up 48% from the lows. That's why it's completely useless to know that it's a recession, because by the time you know it, the market's already up 48%. Okay? So instead of focusing on the economic data and whether we're in a recession, you can focus on the price action if you want. So what do I mean by price action? What I mean is that look at the trend of the market. Is it still on an uptrend or has it reversed into a downtrend? That's all you got to concern yourself with, really. So for example, you can see over here the market was on an uptrend, right? Because the market made higher highs and higher lows. And you can see that initially the 50 moving average, the blue line, was a level of support. And this green line over here, the 150, was also a level of support. So once the market reversed from an uptrend, breaking down, it broke the 50-day moving average, went down, 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 broke the 150-day moving average, the one in green. It broke this moving average and went all the way down. So obviously over here, we know that the uptrend, this uptrend here, has been broken. Now, a lot of people ask me, Adam, should I sell everything when that happens? In the past, I used to do that. In the past, whenever I see, okay, it's a downtrend, I would sell everything and wait for a new uptrend to buy it back. I used to do that in the past, but I don't really do that anymore because I find that many times when you do that, by the time you sell and the new uptrend is confirmed and you get back in, oftentimes you may even get back in at a much higher price. So for example, those of you who understand the moving average crossover, you can see that when the price drops rapidly, by the time the 50 moving average crosses below the 150, which is a downtrend signal, and by the time you sell, you're selling too late because moving averages are lagging indicators, if you will, right? And by the time the 50 moving average crosses back above the 150 moving average, giving you an uptrend signal, and by the time you buy it back, you would have bought it back after it had gone up 48%, okay? So that's the thing. So the whole point is that if you hold on to great companies, you don't have to worry about jumping out, getting back in. Stay invested. That's the most important thing. If you just stay invested, you'll do really, really well. Okay, but of course, don't be leveraged, because if you're leveraged, then these kind of drops could wipe you out if you get a margin call. Okay, and like I said earlier on, when was the recession declared? The recession was officially declared on the 19th of July, which was here. So how useful is that? That by the time they tell you it's a recession, the recession, or rather the bear market already came and went, right? Totally useless. Now, if you look at the more recent bear market over here, now there was no recession during the 2022 bear market, but you can see again the price action, right? So this was a clear uptrend where the price made higher highs and it made higher lows. And the 50 moving average above the 150 moving average and is above the 200 is sloping up. There's an uptrend. And here you can see it's a downtrend signal over there with the 50 moving average crossing below the 150. So this is a downtrend signal there. And then we have a new uptrend signal. So that's what I call the price action. So ignore the economic indicators, look at the price action. But again, more for a trading perspective. If you're investing, you can hold it through the ups and downs, no problem. So where are we right now? So some people are freaking out because yesterday we opened and we closed big. So people think, oh my God, we're gonna die, right? We're gonna die, right? But again, if you take a look at the bigger picture, you can see that the trend has not yet been broken. We are still in this uptrend pattern. Okay, so until it breaks down into a bigger correction or bear market, which I doubt is going to happen, we are right now still on an uptrend. Okay, so let's see what happens. Don't freak out, relax and stay focused on the individual companies and use the chance to add shares to good companies. Again, as I'm making this video, it's about 7:50 a.m. Eastern Time. At 8:30 Eastern Time, the employment report will come out. And like I said, if the employment report is a strong one, then we may reverse back up again. But if it's a weak one, then yeah, we could see a bit more downside, at least for the short term. But as long as the economy doesn't tip into recession, which for now I don't see that, then we should be able to chop around for the next 2 or 3 months and then rally towards the end of the year. By the way, if you want to learn the skills of how to invest in the highest quality companies and learn how to buy them at huge discounts, as well as learn to trade options and stocks effectively, you can grab all my courses and playbooks up to 60 to 70% off for this very limited period. Just go on to piranhaprofits.com and you can click on this link over here and grab our special courses at this special promotion. So with that, I'll see you guys in the next video. Take care and may the markets be with you.